Today's Talk About a Tuesday question is, how should I factor in inflation in my investing and financial planning? Ooh, this is a good one because most people only consider inflation when they're going to the store and want to buy some things and realize the cost of goods and services have gone up. So let's just deal with inflation. Inflation means the rate at which the cost of goods and services rises. And what causes that? There are only two causes. So there are a lot of garbage stuff on social media talking about it printing money and that causes inflation. That's not what causes inflation. There are only two drivers of inflation. The first one is supply and demand, right? So when the demand of goods and services exceeds the supply of goods and services, then the providers will raise the price to knock out some buyers. So that's one driver. The other driver is when the cost of production increases, it forces the provider to raise the price in order to provide the goods or services to the buyer. So that's it. Only two drivers, right? So you have what you call a demand pull or a cost push. That's it. So let's get that out of the way. So how do we plan for this? So we have to understand that it is a natural part of the economy. It will happen and continue to happen year after year. There'll be an increase in the cost of goods and services. There are mechanisms in place to try to maintain a 2 to 3% inflation rate annually. Does it always work that way? No. In the 1970s, we saw over 13% increase in the cost of goods and services annually. During COVID, I think we went up to like 9, or just post-COVID, up to like 9% in a single year. So there are times when we'll see 9%, 10%, 13%, but those are anomalous. Those aren't normal. There are times when we'll see less than 2%. But the average is 2 to 3%. And again, the mandate of the Federal Reserve is to try to keep unemployment at a certain rate, but also inflation at 2 to 3%. They do this by manipulating the interest rate. When they raise the interest rate, it cools off buying. When it cools off buying, then it cools off the demand, and then prices tend to fall back down. So that's important to understand. There is a direct relationship between inflation and interest. And why is that important? When you're planning for the future. Now, this is important. As you're planning, you understand there'll be a 2 to 3% increase over time. On the simplest form, forget your investments for a second, but you have to look at your income. If your income remains constant, but the cost of goods and services increases 2 to 3% annually, every year you'll be able to buy less and less and less. So you need to make sure that your increase in income is on par with the increase in the cost of goods and services, because the same dollar you made today will not get you the same amount of things in a year from now, 2 years from now, 10 years from now. That also allows you to plan for the future of what things will probably cost down the road. So if you're planning for your child's education, you'll get an idea of what it'll cost by the time your child is 18 and ready to go to college. What your budget should look like by the time you're ready to retire. So if you're 40 and you're going to retire at 65, then what will the cost of goods and services look like in 25 years? You can pretty accurately predict that looking at the inflation rate. So that'll give you an idea of how much money you need. So let's just look at your investments. Your investments need to have an interest rate. They need to grow faster than the inflation rate. So I'll give you an example. With fixed income, it becomes more difficult. So when I say fixed income, that's basically interest income at a fixed rate. So as an example, if you look at a traditional savings account, and savings accounts tend to be less than 1%, but let's just use 1% because it's an easy number to deal with. If you get 1% annually on your savings account, but the inflation rate is 3%, then you end up with a net loss of purchasing power at the end of the year. You end up with -2, right? Because if inflation drives it down 3% and your interest drove it up 1%, you end up at a net negative. So you have to look at the things you're putting your money into. But I said there's a correlation between interest rates and the inflation rate. If the inflation goes above 3% and starts to go 4 or 5%, the Federal Reserve will raise the interest rates. So when we have a situation where we have inflation and they raise the interest rates, then it's a good time to get into fixed income because high interest savings accounts, CDs, money markets, like right now, you can get those things at 5%, 5.5%, right? Which is good for a while. When we look at equities, meaning the stock, they tend to, when the interest rates are low, they tend to go up. So it'll be a good time to get into that, meaning looking into the stock market and ETFs, index funds, mutual funds, individual stocks even. Real estate also tends to increase in value with inflation, but easier to purchase when we have inflation because they'll bring the interest rates. When there's inflation, they'll raise interest rates, so you don't want to buy at that time. When they lower interest rates, then it's a good time to buy real estate to take advantage of that growth that's inevitable. So equities, meaning things in the stock market, and real estate tend to grow with inflation, and you tend to be able to take advantage of fixed income when they're doing things to cool inflation. So what's you have to balance your portfolio. You have to have a diversified portfolio of fixed income, equities, and real estate all the time. And you just rebalance it, meaning you put more stuff into the area that's growing at that time. But they don't both tend to grow at the same time. It just doesn't work that way. So how does it factor? It factors into the diversification of your portfolio. It factors into how you weight that particular thing in your portfolio at that time, meaning you put more stuff in when that thing is growing during that phase of inflation, and you put less in when it's in a lower phase based on what's growing at the time. So hopefully that makes sense. I know it sounds complex, but it's really not. There's a very direct correlation between interest rates and inflation rate. They're opposites, right? So there's an inverse correlation between the two. When inflation is up, it's usually because interest rates are down and people are borrowing more and spending more. And when they do that, it causes inflation. So to cool that, you raise interest rates to stop people from buying. So when you raise interest rates to stop people from buying, fixed income. When interest rates are low, then stock market and real estate will do well. So when interest rates come down, you put your money in the stock market and real estate. When interest rates are up, you put your money into fixed income, bonds, high interest savings, money market, CDs. But you're in all those things all the time. It's just when you dump more money into it, right? You dump more money into it at the correct phase. So that's how you deal with it in terms of your investments, in terms of your financial planning. It's a good way to look at inflation to see down the road how much you need in terms of planning for future events. But there's no way around inflation. Remember, there's only two drivers of inflation. It is what it is. You can't change that. So you absolutely have to factor that in order to plan properly. So I'd love to hear your thoughts on this. Please like, share, subscribe. Keep the questions coming, and I'll see you next Tuesday.